Guys, welcome back to our non-QM webinar mixer at A&D Mortgage. Thank you so much for joining. This is week number 2 of our 5-part series, and we hope you'll join us for the remaining 3 over the next 3 weeks. Today, we're focusing on bank statement loans and how they can be a perfect match for borrowers that are self-employed. Be sure to submit your questions and, of course, share, as we'd love to get the word out of how A&D Mortgage could be a perfect fit for you if you happen to be a mortgage broker. We'd love to hear from you. We'd love to answer your questions, so send those in. I said it last week and I'll say it again, but we wouldn't exist without you, our broker partners, and we want to provide you with as much value as possible. I'm David King, Chief Marketing Officer here at A&D Mortgage. I'm going to be bringing on 2 guests today. Carla Bianchiello. She gave me the pronunciation yesterday, but I just butchered it, so forgive me, Carla. An account executive from New York, and Jerry Maharo, a regional team manager from California. Let me introduce Carla. She's an industry veteran of over 30 years. A&D Mortgage is only the third mortgage lender that she's ever worked for in 30 years. That's crazy. She has experience in subprime retail, but her heart is wholesale, she told me. Non-QM is her specialty and says that is the reason she joined A&D Mortgage. So let me bring on Carla to this stream. There we go. Carla, welcome.
Hello, how you doing, everybody?
Doing well. Carla, you and I met in person for the first time last week, and you told me that you had a nickname at previous companies, and you built a little mini brand around it. To tell our audience what your nickname was.
Yes, I was nicknamed Closing Carla because I always smashed my goals and broke records and remained #1 with the company I worked for.
Yeah. So. Well, thanks for joining. Next, let me introduce Jerry. Jerry, like I said, is a team manager out in Irvine, California. Just visited him a couple of weeks ago, met the team and had a great time. But Jerry has been in the industry for over 20 years now. You got some background music or some noise going on there, Carla. But Jerry's been in the industry for over 20 years now. So, Carla, you've got him beat by 10. He also specializes in non-QM, non-prime wholesale lending. He's a graduate of San Diego University, and he's been with A&D Mortgage for almost 2 years now. He loves concerts and traveling with his family. So welcome to the stream, Jerry. Good to have you.
Thank you.
All right, so let's jump into our next. So like I said, this is week number 2. And we have 3 more weeks to go. So just real quick, next week we'll be talking all about jumbo loans. June 15th, all about DSCR. And then on June 22nd, we're going to be looking at all the questions that come in over the 5 weeks. And then we're going to have a very special guest on the final webinar on June 22nd. So join us. Make sure you mark your calendars. Join us for each one. In mid-July, we are going to have a standalone webinar featuring an absolute powerhouse, somewhat of a celebrity in the mortgage industry. You all know who it is, but stay tuned. We're going to be announcing that over the next few weeks. We're excited about it. So first, let's, Carla, Jerry, let's begin with just kind of a quick overview of non-QM loans. Carla, answer this for me. How do non-QM loans and conventional loans differ?
They differ drastically. A conventional mortgage today is underwritten based on findings for DU, Fannie Mae or Freddie Mac guidelines, and non-QM loans are the complete opposite. They are manually underwritten, and they are basically for customers who cannot provide the standard documentation that a conventional mortgage can. So it saves a lot of loans that otherwise would not be able to get done. Mainly for self-employed borrowers, where they don't report all their income on their tax returns, or they report a loss. So we use alternative documents to qualify them, such as bank statements, P&L, and other various sources, depending on the customer's income.
Gotcha. Jerry, today we're talking about bank statement loans specifically. Just give us a quick overview of bank statement loans. What are they? Who are they for?
They're for the self-employed borrower, really the borrower, like Carla mentioned, that writes too much stuff on their taxes, too much write-offs. They can't qualify for a QM loan. So we take their bank statements, whether it's 12 months or 24 months bank statements, and we analyze them, look at the deposits, and give them as much income as we can.
Gotcha. So did a little bit of research. The number, of course, fluctuates, but there's roughly 10 million self-employed people in the US, which is roughly 7% of full-time working Americans. Carla, historically, talk to me about why sometimes it can be a challenge for the self-employed to get a mortgage.
Just to cap off what Jerry said as well, the customers that are self-employed don't always report all their income on their tax returns, or their accountant will write off their expenses and a bottom line number will end up at zero when they're actually earning more than that. And we do understand that. And that's why there's the alternative lending for it, which we call non-QM today. And it basically will allow them to get a mortgage. Yes, the rates are typically a little bit higher than the conventional rates out there, but if you're not reporting all your income, you should not qualify for the same mortgage or rate that a traditional borrower could. So the good news is we are able to help those borrowers and get those loans done with alternative documents.
Jerry, bank statement loans are one of our more popular loans. Talk to me about why that is.
I think, when non-QM first came out, that was really the product that came out really strong, trying to service that percentage of the market that's not able to qualify for a mortgage loan, even though they have really good income and really good credit score. The profile is an A+ borrower. So I think through time that most lenders have focused on that, and the way we look at bank statements and how we calculate them has changed in the last few years to make it even more aggressive and better for the borrower, the consumer.
Jerry, can I jump on? I just want to add on that.
Sure.
Because the bank statements, just so that people understand, we're going off your business receivables. So that they see that there's constant cash flow coming in, that's where the mortgage is made off the bank statements as well. Because sometimes people think, oh, bank statements, not tax returns. It's, again, business receivables based to calculate the income rather than just the income you're earning or paying yourself as a self-employed person.
So we've said the word self-employed has been mentioned quite a few times already. Let's define exactly who these loans are for, because you've got business owners, you've got independent contractors, and maybe some more areas. So bank statement loans, it's not just for business owners. So talk about that.
Jerry, me?
Yeah, it's, it could be for someone who's they don't have own their own business. They could be a contractor, an Uber driver. They could be an independent contractor with different companies, and where they could show obviously their income going in to their bank statements. And whether it's, sometimes we even take personal bank statements. So it doesn't have to just be business bank statements, and also personal bank statements that we use.
Let me bring up this slide. Let's get into some more of the meat of it. Carla, walk me through the bullet points that you see here on the screen and just add some commentary around it.
Sure. The self-employed borrowers, no tax returns are needed, only bank statements. Again, I feel like we're repeating ourselves, but you can't hear it enough because we're still asked the same questions every day as much as we repeat it. You're using business receivables. You have a business bank statement or a personal bank statement. We are able to use that to qualify the borrower. We take the deposits and average them. And again, it's dependent if you're doing business or personal, the percentage of deposits that we'll use. The next bullet there, easy to calculate the monthly income as a broker. If you're unsure of doing this or do not want to do it on your own, we have an awesome concierge service right on our website that you can upload those bank statements to, and they will be calculated for you within 24 to 48 hours, and they'll send back a spreadsheet for you, and we can discuss it if there's any discrepancies there or you have any questions. And of course, the higher the credit score, the lower the interest rate. That goes with any loan in the industry, but even more so with these type loans. And the more down payment you put will also derive a lower rate. So I do want to mention as well, the rates in the world today are in the threes. On this program, I've locked a couple of loans this week at a 3.875. So when we say that the rates might be a little bit higher, they're just higher than the normal traditional borrower, but they're still very low and very aggressive and competitive. So depending on the scenario, the credit score, the LTV, and what we're doing for that borrower, which documentation you're providing, your rates are still going to be very competitive and aggressive.
Gotcha. Let me pause there just for a second for anyone that's joined the broadcast in the last few minutes. Whether you're watching on LinkedIn, YouTube, or Facebook, feel free to send in any questions that you have for Jerry or Carla, and I've got a team behind the scenes. They're going to filter those questions to me. So ask away. We'll answer those questions as they come in. Actually, just got a question in. And when conventional loans are going off, non-QM loans can still help one to secure a mortgage loan. Jerry, did you want to add anything to what Carla said on these slides?
Yeah, it's just, calculating income is pretty simple if you're a broker. We have that concierge service. Even our AEs will go ahead and help you walk you through it, the first couple times. But the easiest way to do it is send it in to our concierge service, and we get it out back to you within 24 hours.
Gotcha. So let's move to the next one. Talk about, Jerry, just like Carla did, add some commentary to these bullet points that we see here.
Yeah, it's basically, like we've been saying, for the self-employed borrower, we don't need tax returns. You can either use 12 months or 24 months. We're going to look back. We need 24 months in a row. So, or we need 12 months, the last 12 months in a row, and calculate that income to give gross income. And we go up to $1 million, which is really good, and $1 million cash back. So it's really, obviously, when we're looking at bank statements, there's, other than just looking at the deposits, we're also looking at if they have NSFs, if they have overdrafts. So there's a lot of moving parts to bank statements, but let us do the work with our concierge service and give you the right numbers so you don't have to deal with it.
I think we get into this possibly in one of the future slides, but can we combine income if a co-borrower is a W-2 employee?
Yes. So as long as our primary earner is self-employed, then we could use a co-borrower as a W-2, and we won't ask for just 4506 for that person, nothing for the self-employed borrower.
Okay.
We can combine.
Gotcha. What about underwriting? Talk to me about the differences in underwriting and how we calculate eligible deposits.
Carla, you want to take that?
Yeah, we will use direct deposits that are consistent throughout the months. Any large deposits will be backed out. We cannot use transfers from other accounts because that's only going to cause them to pull in some more questions there. It's pretty simple. If your business bank statements, the general rule of thumb is 50% of the deposits. If you're using personal bank statements, we can use up to 100% of deposits. I also want to mention, if you're doing a business bank statement program, and let's say for argument's sake, you need more than 50% of deposits, but you can get a letter from your accountant for a CPA for your expense ratio that your expenses are lower than the 50%, we can go as high as, I've seen 95% of deposits being used on business bank statements. So again, the 50% factor that we use is to cover for overhead, employees, and expenses to run your business. But if they're the reverse, because you have a smaller business or you work out of your home or you don't have a large overhead, they can use up to 95% of deposits with a CPA letter. So again, the flexibility and aggressiveness that is available with the underwriting of these programs is huge. Again, the complete difference from a conventional traditional mortgage where you have to fit in the box with pay stubs and W-2s and qualify based on Fannie and Freddie guidelines. This is not that.
Gotcha. Hey, I've got a good question from Manuel Borda. Thanks for the question, Manuel. What happens if they have an overdraft?
We do allow for a small amount of NSFs, they're considered, or overdrafts, insufficient funds, throughout the 12 or 24-month period. They don't want a lot of them. They want a letter of explanation on why it happened that month. Usually it's an accounting method or such, and that's okay. But if you're giving me 12 months bank statements and you have 25 to 30 overdrafts, then something's wrong because you're not managing your money properly. So depends on the number.
Sorry, Carla. The good thing with us is, say the standard NSFs is 3 per period. So if you're doing 12 months, we don't want more than 3 or 24 months. But say they had 10 and it's isolated to maybe 1 or 2 months, explanation letter, account executive will go in there, request an exception for those NSFs, and most of the time we'll get them. And again, if they're continuously every month, 20 to 30, whether they're NSFs or overdrafts, we're probably not going to get them, but would definitely, if it's into a specific period of time and there's a good explanation about that, we could go ahead and request an exception for that.
Excuse me. Question from Fox, Evelyn, Lisa. How do you calculate the deposits?
Again, depending on your bank statements, if they're business, you take 50% of those deposits, divide by 12 or 24, and divide by 2, because that's cutting those deposits in half if you're doing the business bank statements. If they're personal bank statements, same thing. You're adding up the 100% of deposits and dividing by 12 or 24, depending on the number that you're providing. 12 is usually going to work better for you, and especially with the pandemic recently in the past months, because some of the businesses' income had slowed down. So the recent 12 over 24 is always going to give you a better number.
Let's move to requirements. Carla, I'm just kind of bouncing back and forth.
That's all right.
Carla and Jerry. Carla, walk me through some of the requirements here.
The borrower does need to be self-employed, but they do not have to own 100% of the business. Depending on the percentage of the business they own, that's the percentage of deposits we'll use. So if they own 100% of the business and our guidelines using 50% of deposits, that's what they use. But if they own 50% of the business, then we're going to use 25% of the deposits, and so on. Verification of the business is a business license, articles of incorporation, operating agreement, something to prove that they own it. Even if it's a smaller business, they'll take a website listing and such. And length of time owning the business is minimum of 2 years. So it could be a little less with an exception. Let's say they're in the same line of work. And Jerry and I are going to hear the word exception a lot, because things making sense and underwriting based on longevity in the field and experience, they will make those exceptions. But typically it's 2 years you need to be self-employed or owning the business.
Is there a minimum amount of the business that they have to own? Is it 10%, 20%?
Nope. It's just whatever they own, that's the percentage that's going to be less than that of the deposits we're using.
Now, but they have a restructuring of the business, say they went from a DBA to an LLC corporation, and they did it within those 2 years. As long as we could establish that the business itself, the entity, the DBA was 2+ years, then we go ahead and that'd be okay. That wouldn't be an issue.
Gotcha. Okay, let's move to personal bank statements versus the next slide. We'll see business bank statements. So Jerry, walk us through this.
So, like we mentioned before, on personal bank statements, if it's 100% personal, they're not using using that bank statement for any business purposes. We'll take 100% of those deposits, and that's going to be their gross income divided by either 12 months or 24 months. If they are using that business personal account for business purposes, we could see business deposits going in there, then we're going to look at it as a commingled account, and we're going to categorize it as a business account. So at that point, what Carla kind of explained earlier, we'll take 50% of it or we could get a CPA letter or a tax preparer. It doesn't have to just be a CPA. It can come from a tax preparer also.
The next slide I'm going to show is business bank statements, but let me go back. Juan and Carla, anything to add there?
No, Jerry pretty much touched on it.
Yeah.
I'm usually not at loss for words, but you did good, Jerry.
Another question just came in. How does the expense factor work? What is the maximum loan amount on a bank statement loan?
3 million is our guideline, but I've personally had exceptions done over 3 million and closed well. So it really depends on all the compensating factors, the credit score, their equity position, what they're putting into the deal, if it's a purchase, if it's a refi. So 3 million is typically the guideline, but always question and check.
There you go. Carla, anything to add since we moved from personal bank statements to business bank statements? Any bullet points that you'd like to draw attention to here?
When you calculate the income, that bottom line number has to match what's on your 1003. So when you're submitting the loan, make sure before you do the calculation or when you get it, that it matches the number that's on your 1003. If it doesn't, it may cause an issue. And then underwriting will, of course, calculate the final income again, but that concierge service is important to use and very helpful tool. I could do them for you as well and teach you how to do them, but it's a very simple way to have them uploaded to our concierge service.
Jerry?
Yeah, back to the 1003. If you have any doubt ever, just put the gross amount of the income. And so because we don't want it, we'll use the lower of the two, whatever our calculations come up with, or what's on the 1003. So if you end up putting a lower amount on the 1003, then that's what we're going to come up as their income. So it's always good. Either if you put the exact amount, if you send it to our concierge service and you know exactly what income we're going to give them. If you have any doubt, you could always just put the max income and then we'll just take our calculations.
Gotcha.
Also, Jerry, you can use up to 2 accounts per business. Doesn't have to be one set of bank statements. But when you're using multiple accounts, just be careful because that's where there's transfers and money going back and forth and things will get backed out and that can cause an issue. So you can, if they have 2 separate businesses and there's no transfers and nothing goes through it, yes, 2 accounts are fine. And our debt ratio on these programs are 50% or less.
I do have to point out, I got to pick on my buddy Mark Glazer from last week. You guys aren't as fancy as him with pronouncing it concierge. So
that's right.
Concierge.
Jerry, talk to me about the different profiles when it comes to credit events.
So when it comes to credit events, we do have 2 different set of matrices for the borrowers. So we really look at the credit events, anything 12 months or less than 24 months, it goes into our prime. And then if they've had a credit event, a bankruptcy, foreclosure, and it's been over 24 months, then they go into our super prime, which is going to give them the best rates that we have. Go ahead.
Me or Carla?
Carla.
I'm good. You said it. What else? The credit events?
Oh, the one other thing you just have to watch out for the super prime. If they have a 1 times 30, multiple 30s, that'll bring them down to the prime. But if they have a 0.30, then they're good with the super prime.
Yeah.
And the good thing to look at when you look at that little section there where it reserves on all our income-based products, they only need 3 months reserves across the board, whether you're going 50% LTV or you're going to 90% LTV.
Correct. And cash out, if it's a refi cash out, that cash out could cover the reserve requirement.
Manuel Borda asked a good question. Can I use an IRS refund?
As a deposit, one-time deposit, most likely not, because it's not consistent.
No, so it's going to be income driven. So it has to be income driven from your business. Right. So when we're looking at bank statements, we're looking at the general deposits and looking at the average deposit size. So if you have a deposit, say their average deposits are 10 to 15,000, say a week, and all of a sudden you have a deposit in one day that's 30,000, you're going to have to source that deposit, see where it came from, and we'll count it. If not, then we'll back it out.
Gotcha. Carla, walk me through our concierge services and what that looks like and the value that adds.
Okay. Well, the broker just has to go to admortgage.com, and you'll see up on top it says resource. It says right on the top front page, do not log in, because a lot of our brokers have their credentials and they log into the site. When you're using the concierge service, do not log in. So it says it right on the front page. They upload the bank statements. They'll get an email back saying, thank you, we received your bank statements. You'll have a response within 24 to 48 hours. They'll get an Excel spreadsheet back with all the deposits and any backed out with a bottom line number, monthly, over 12 or 24, depending what you're submitting. And then they even give sometimes the CPA example with like 65% of deposits, just to give an example if you need a little bit more. So very helpful. Sometimes I've seen the concierge desk even email back one of the bank statements overlapped or they were missing one. So there's a little back and forth with the broker and the concierge. It works great. It's our assistant.
Gary, anything to add about the concierge service?
No, just that when you're submitting those bank statements, making sure you're submitting every single page so we may have an accurate count. Even if it's blank, just go ahead and submit it, especially when you're submitting it into a real submission into underwriting. We need every single page that's on there. So a lot of times we're missing pages, and that's when it delays the underwriting.
Yep.
Yeah, I think if you're in the mortgage industry and you happen to jump on Facebook or Instagram or anywhere, we've all seen the memes of frustrated originators with not getting all of the bank statement pages, every single page.
Yes.
Yeah.
Yeah. So
Even if it's blank, we need it.
That's right. I'm going to try and wrap up on time. We're scheduling these for 30 minutes every week, so I'm going to try and wrap up on time this week. I ended last week by asking Mark Glazer about our tagline, the power of yes. And like I said, what does that mean exactly? Talk to me about how we approach really trying to find the best program for, especially with us focusing on non-QM. Talk about kind of our mentality there, really kind of figuring out the best program for our brokers and the effort that we put into it.
I think what we do is like Mark mentioned last week with our securitization, it gives us the opportunity to really look at what the market is doing and give the best possible product, whether it's rate, whether it's LTV, whatever it is, to the borrower. And we look at it, it's the power of yes. We're trying to give you a yes. So we're back again to the exception. If we need one, does it make sense for the borrower to go ahead and get that exception? So we're always looking to make it better for the broker and for the borrower. Just this week, we came out with new rate sheets for non-QM, and a 12-month, there's no add-on anymore for a 12-month. Same pricing, whether you do a 12-month or a 24-month bank statement. So that's something else that we're adjusting as we go.
Gotcha. Last question that just came in. I think we still have enough time. What's the main difference between 12 or 24 months? Is it primarily the rate? What is it?
Yeah, it would have been the rate, but now we reduced that hit if you were giving only 12. So it's going to be mainly the rate. But again, like I mentioned earlier too, 12 months is going to give you effectively more income than 24 months. So it's very important to see which benefits the borrower more. And it's usually going to be 12 months to get more income, more bang for your buck, I should say.
Gotcha. Well, guys, let's wrap this up. Jerry, Carla, I appreciate you taking the time to educate our brokers, everyone out there on social media that happen to watch. If you've attended, we really appreciate it. We'll be putting this and future webinars, recordings of those on not only, of course, social media, but on the homepage of our website as well. So if you want to go back and reference any of the information that Carla or Jerry shared, you can always go to admortgage.com and you'll be able to find this information and a lot more. So to our broker partners, we really appreciate your your partnership. And if you're not a broker partner, we hope to partner with you in the future. So Jerry, caller, thanks so much for joining, and we'll see you next time. Take care.